Welcome to the monthly roundup from Kepler Trust Intelligence in association with Schroders. In this edition, Ryan, David and I will be covering all the news in the investment trust world over the month of May. So Ryan, could you kick off proceedings with an overview of the news stories that have caught your eye over the last month?
Hi Joe, thank you and welcome back everyone. The month of May has been full of news, both on a wider macro level and in the investment trust industry, most of which in our industry in particular centres around all the activist activity, primarily around cyber capital, which we have covered many times before. With so much activity, we're not going to go through each news item one by one, but instead look at sort of the repercussions of what this is having across the wider industry. Now, firstly, there have been several outcomes for some of SABA's direct targets, including MCT proposing to move to an active ETF model, CQS offering a 100% tender offer, similar to what ESCT offered in the past month that we covered. And we think this demonstrates to shareholders that boards have really woken up to this activist threat and are finding solutions to these issues that the activism has highlighted.
And has this had an impact on any other trusts?
Arguably, yes. There's been sort of several announcements from other trusts that are not currently the recipients of activist activity, with proposals for very shareholder-friendly measures that should, in theory, lead to better performance or support narrowing discounts. There's been the introduction of some conditional tender offers at the likes of Baillie Gifford. JP Morgan, with their India Trust, has announced changes to its tender offer program, as well as introducing a dividend and announcing a sizable buyback program. And then also PCFT, the only financials trust in the sector, has announced the adoption of an enhanced dividend strategy. Now, this not only adds yield consistency for shareholders, but also frees up the managers to potentially find more alpha generating opportunities. So whilst the cyber activity has caused a lot of consternation amongst managers, boards and investors, it has sort of arguably led to a slew of shareholder-friendly measures being adopted, with stakeholders concerned about the future of their trusts, and the fear of taking their shareholders for granted has sparked some activity, perhaps for the longer-term benefit of the wider industry.
Yeah, it's going to be really interesting to kind of see how that rumbles on as well. Now, elsewhere, a rather well-known name has entered the investment trust sector with Rockwood. Can you talk us through that?
Yeah, of course. As you said, the investment trust world welcomes a quite well-known name to many in Richard Pease, who has joined the team at Rockwood Strategic. Now, Richard has a very long-term track record in the investing world, primarily in the open-ended space and in European markets. He headed up European teams at Jupiter, New Star, Henderson, before ultimately founding Crux Asset Management about a decade ago now. He brings with him sort of a wealth of extensive experience running portfolios, investing in equities, and really knows how to sort of work and engage with companies.
So how do you kind of see this benefiting Rockwood?
Well, Richard Pease has joined the investment advisory group that helps support the Rockwood Trust, as well as sort of a number of other vehicles under the Harwood Group, headed up by Christopher Mills. His experience is likely to be particularly helpful with the Rockwood's active engagement approach, which often includes taking board positions of portfolio holdings and helping to instigate turnarounds. We believe having such a big name with so much experience in Richard Pease will really add some of the heft of some of that corporate activity and help accelerate some turnaround strategies. Now, Rockwood has already delivered some exceptional numbers since it became part of the Harwood stable and reinstated Richard Staveley as manager, all of which you can read about in the recent note we have just published on the KTI website.
And that's a great segue into our next section, which is results. David, perhaps starting with you?
Yeah, so we'll kick off with Picton Property Income. Now, obviously, you can kind of see the results on our website. We'll give you a kind of quick overview of these. Now, Picton recorded a net asset value total return of 8.1% for the year and profits of £37 million. Now, property seems to have kind of potentially turned a bit of a corner recently with a fierce pace of M&A activity within the REIT sector over the past few years. This has culminated in much better share price total returns. Picton's were about 16% over the year, and the discount narrowed from 32% to 28%. Overall, we think that Picton's disposal program provides a great case study on just how kind of active asset management can create real value within real estate and property. The trust has successfully walked assets through the process to allow a change of use, say converting an office building into student accommodation before offloading it.
And what about the dividend?
So the dividend is certainly important for Picton, as one of its primary goals is to maintain and grow a fully covered dividend. In its financial year, it grew the dividend by almost 6% while keeping dividend cover at 1.13 times. Now, Picton's dividend yield is 4.8%, which is slightly higher than the yield on a 10-year gilt currently, but with interest rates set to drop further, both the yield and discounts could start to look attractive in the coming months.
Moving on from property now to something completely different. Joe, we had half-year results from the International Biotech Trust. What were your thoughts on these?
Yes, overall, a strong performance from IBT. They delivered a positive NAV return against a negative return for the Nasdaq Biotech Index. And we think that's testament to the manager's abilities to outperform in both rising and falling markets. And this resilience is partly due to the basket approach that they take to therapeutic areas. So rather than trying to pick the winner, they're investing in a few companies with the same target. Yeah, once again, we saw M&A being a major driver of returns as Big Pharma turns to biotech firms to plug their looming patent cliffs. So we saw Johnson & Johnson pay a near 40% premium to acquire intracellular therapies for $15 billion. And that was IBT's largest holding at the time. Merck have also made an offer for another portfolio company, Springworks, since the period end, which makes it going on for 30 acquisitions for IBT since 2020. So a really impressive hit rate on that front.
And with all the sort of tariff speculation going on, how has that hit the biotech sector and the outlook for IBT?
Yes, clearly, as we know, the biotech sector is very sensitive to news flow, particularly around US policy on both tariffs and also the impact of RFK on drug approvals. We also know it's a risk on index, so we've seen the MBI fall significantly this year, although it has recovered to around a 5% year-to-date loss at the time of recording. That said, the managers elsewhere in Merrick, they think the current dislocation will unwind in time, given strong fundamentals and also valuations in the smaller cap space in particular remain at historically low levels. So IBT overall provides exposure to a really exciting growth market, and biotech should be a prime beneficiary of a lower interest rate environment. So I'd say an attractive entry point for investors willing to look beyond the short-term noise.
And now finally, Ryan, you had two results from Schroder's Asian desk as well.
Yeah, that's right, David. May saw interim results for both Schroder AsiaPacific and Schroder Oriental Income. Now, whilst the period covered for these interim results was quite short, only a half year, 6 months, China was a major factor for performance. The country rallied in the period, both on the back of stimulus measures and then again from the launch of DeepSeek, which helped the smaller cap sector. And this was a major factor for performance. So the China allocation did help in absolute terms, although because the managers are underweight in both trusts, this was a headwind and resulted in both underperforming. However, they are overweight Hong Kong sort of to try and offset this, which did help a little bit. Over the longer term, though, this positioning has been very positive to performance. Both trusts have delivered 5-year outperformance of their respective benchmarks, although, this did narrow slightly in the near term. What we think is quite important is that, once again, stock selection has been a very positive factor, especially in the likes of Singaporean financials, which held up well in the higher for longer interest rate environment. And both trusts continue to offer very quality exposure to a region that offers quite considerable potential, but is facing some macro headwinds at present. Both trusts have a bias towards the more developed markets of the regions, like Singapore, Australia in some cases, and these can arguably do quite well in a challenging environment. So whilst the China underweight may have been a slight headwind to performance, it means that it could appeal to many investors who also share the manager's concern over the country and the structural issues it is facing. And while still capturing exposure through an overweight to Hong Kong, which is tied to China's fortunes, but with arguably better governance issues.
Yes, there's some really kind of interesting developments in Asia in particular, I think. And Ryan, you were on the This Is Money investing show this month to discuss just that topic.
Yeah, thanks, David, for bringing that one up. A rather nerve-wracking interview on video as well, discussing Asia in the midst of a trade war. We'll share a link for that in the description for those who would like to see it.
Sure. Now, moving on, Joe, you caught up with Jean Roach from Schroders. Now, what did she have to say about UK mid caps?
Unsurprisingly, quite a bit, actually. So we start off by talking through the investment case for UK mid caps. which Jean described as offering quite a menu of discounts versus the FTSE 100. So, for example, a 20% PEG discount or 40 to 50% off in terms of price to book ratio, but still a 4.1% dividend yield compared to 3.7% for the big caps, plus forecast earnings growth of 16% this year. So some quite tasty fundamentals on the table on that front.
Yeah, so potentially some kind of promising signs for UK mid caps at the moment. And you also kind of touched on the T word at some point, did you?
We did, funnily enough, though it's worth saying up front, there's a roughly 50-50 split by revenue in the UK mid-cap sector, so they offer the option to tilt either towards domestic or international exposure. I think Jean felt that the proposed 10% UK tariffs could throw, as she put it, a bit of grit into the system, but we are in a better position than other countries if that's not a race to the bottom. And also the benefit of being familiar with your home market and using that first-hand experience to dip into pockets of growth. And on that topic, there was a very entertaining account of Jean's family day out to test the offering at Curry's.
Yeah, clearly you're never too young to learn the basics of due diligence.
Absolutely.
Now, where is Jean seeing the most exciting opportunities at the moment?
Indeed, we've spoken about Games Workshop before. It's been one of the success stories of the FTSE250. It's now in the big league of the FTSE 100. But Jean used it as a good example of a company that's been reinvesting surplus cash into the business rather than making value-destructive acquisitions. And also opportunities in the defence sector, which has gone from somewhat of an ESG pariah to the front page golden child. But Jean highlighted some of the less obvious angles to play the defence supercycle, so perhaps logistics, industrial storage, the picks and shovels plays. So yes, plenty of opportunities there for investors.
And Joe, you also chatted to Bianca McMillan from Gravis for our Market Matters podcast. Can you kind of talk us through some of the highlights from that one?
Yeah, Bianca started off by talking about the benefits of an allocation to energy infrastructure. So you're investing in a long-term, big capital tickets with contractual and often inflation-linked revenue. So a good diversifier in the volatile markets that we're seeing at the moment. But also the merit of the trust structure in being able to take a longer term view, as well as investing directly into the less liquid infrastructure assets.
And what does Bianca see as some of the key drivers of performance over the next few years?
Yeah, unsurprisingly, interest rates top the list. Higher for longer rates, as we know, have been a drag. So a falling rate cycle could be a strong tailwind. And while inflation has been stubborn, infrastructure funds should hold their own thanks to those inflation-linked contractual revenues. So all in all, a potentially more benign backdrop for the sector going forward. And moving on, David, you had the chance to speak with Annabel Brodie-Smith from the AIC for our Market Matters podcast. What did she have to say?
Yeah, it was a really interesting chat, actually. We covered plenty of ground, as I'm sure you're not surprised to hear.
Nope.
Annabel's been with the AIC for almost 30 years now, so, there was a lot to kind of chat about. So, as ever, we kind of started off with some lighter topics, particularly like the anecdote of how kind of Annabel and a former colleague created the dividend hero idea back in the days of the global financial crisis. And that kind of led us on to a bit of a conversation on the income benefits of investment trusts, which are, obviously one of the kind of big structural advantages that they have. But then we did manage to get into the meat of kind of current investment trust issues, discussing things like Saba's activism, as well as the future of the sector.
And with that in mind, David, did Annabel give any sort of outlook of what the sector is going to look like in a few years' time?
Yeah, I think kind of the same as many, I think. Essentially kind of fewer trusts, but much larger ones. I think she agreed that the consolidation of the sector that we're kind of seeing at the moment will most likely continue to run, and that the remaining successful trusts will be of much larger scale. Now, hopefully this will eventually lead to a renaissance in the sector. Elsewhere, we also talked about the double counting of investment trust costs and wide discounts, but also a little about voting rights. And I wanted to kind of take this opportunity to remind listeners that the AIC has launched a petition to try to get lawmakers to ensure that investment platforms are required to pass on voting rights to their customers.
Okay, so moving on, Joe, you covered the most and least popular shares and trusts with UK investors in the past month. So who was hot and who was not?
I'll only mention the stocks in passing, but once again, investors loaded up on high-yielding UK blue chips such as L&G and GSK And speaking of the defence supercycle, there was a tactical retreat. We saw some profit taking on Rolls-Royce and BAE Systems. The most bought trust list, however, has started to resemble the processional spectacle of the Monaco Grand Prix. It seems almost impossible to overtake Scottish Mortgage, which chalked up its third position on pole, with City of London and JGGI once again making the podium.
And sticking with SMT, did their latest annual results reveal any sort of interesting portfolio changes?
Yes, so staying with the F1 theme for a moment, SMT has eased off the throttle on Ferrari alongside Amazon, Netflix, Nvidia and Tesla, leaving the trust underweight North America relative to global indices. Now, revving up in their places were Hermes, TSMC, Tesla rival BYD and privately owned Revolut, which has finally crossed the finish line on its UK banking licence after 3 long and painful years. While SMT has returned to outperformance on a NAV basis, its discount, however, tells a different story. It's bought back nearly 15% of its shares, reportedly under pressure from Elliott Associates, but despite this, the discount has doubled over the past year. So it seems that investor sentiment isn't quite ready to rejoin the fast lane, and on that note, here's hoping for more of a Shanghai-style reshuffle next month. Now, David, it was your turn to lift the bonnet on your own portfolio. What have you been thinking about over the past few weeks?
You're probably the same as everyone else, I suspect. Trump's tariffs have certainly been kind of high on the agenda. But particularly, since I was writing kind of 5 weeks after Liberation Day, I think just how surprising the bounce back has been. In the days after the imposition of tariffs, people were kind of speculating that volatility would rumble on for a long time and there would be, repeated kind of buying opportunities because of them. Fast forward to today, and while US markets are still down from the kind of record highs they were trading at the end of last year, they have certainly made up all of the ground they lost in early April. Now, specific to my kind of portfolio, I was a little bit disappointed that I didn't take advantage of the falls kind of as much as I should have. I'm still drip feeding in a lump sum into markets to benefit from pound cost averaging. And I thought that, having that cash on the sidelines would give me good firepower when the next crash came. Didn't quite happen. I did manage some investments that kind of look a little bit successful at the moment. Allianz Technology Trust, Merchants Trust, Lululemon and Lam Research have all done really well, but they're quite small positions when they were opened, and they've already gone up by a good kind of 12 to 25%. So maybe I've missed the boat a little bit. Of course, we've got another month or so until the current tariff pause supposedly runs out. So we'll see. Perhaps we'll get another chance to buy more if Trump decides to reinstate the tariffs, but who knows?
Absolutely. Certainly some very interesting times at the moment. But that is it for this month's edition of Investment Trust News. If you'd like to find out any more information on anything we've covered in the podcast this month, please visit the KTI website, and we hope to join you again soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.